Here, I'm Rich Swerbinsky with Downward and Upward Consulting, joined as always my esteemed colleague and co-host Rob Krisman. Rob, good to see you today. How's things?
Things are good.
All right. And this
There's
week,
I'm in San Diego right now, and it's June gloom. So I'm looking out the window at the Coronado Island. It's just gray.
that's
It's
a
probably
beautiful.
beautiful where you are. Beautiful.
Yeah, it's mid 80s and sunny and yeah, it's one of the best weather months. Chris, Michigan, same. I'm sure. Like May was incredible in Ohio. The weather.
There's a I don't really ski, so for me, there's only about 4 good months a year in the great state of winter water wonderland of Michigan, and this is one of them. So it gets dark at 9:30 at night, 75, 80 degrees every day. Doesn't get
You
any
know,
better. I can't say much for the other 8 months, but these four are pretty good.
so Chris, let's go forget the mortgage stuff right off the bat here. A week or two ago, I sent this article, and everybody had seen it to some friends of mine in Michigan about the fellow who was driving with a suspended license, and he was on his computer, I think, or on some kind of Zoom call with the judge.
Oh yeah, right. I saw that too.
And then tomorrow's lead off, I think I have it. I don't know what I'm writing about tomorrow in the lead paragraph, but the state of Michigan, congratulations, has surpassed the state of California in cannabis sales.
We have
So
a lot of
hats
people with a lot of anxiety here, Rob.
apparently. So there's the long winter, it's the winter months apparently. So
I can't believe
congratulations.
that. I can't believe we could outcompete a state that's 4 times our size and population, but it could be that they're only measuring legal sales. So perhaps California has a much more rambunctious and roaring underground economy than we do. Up in Michigan here, we're very happy to pay our pot taxes.
We call it the robust underbelly of the
Yes.
economy here.
Michigan, in related news, also now #1 flaming hot Cheeto sales.
Really? Oh,
Yeah, I don't know if those two are correlated, but
what is actually the #1 munchie food? There's got to be some sort of survey that's been taken, right?
was that stat real, Rich?
no, I made that up.
Yeah, me
Well, it
going.
could be true. Yeah. So, but anyway, let's introduce our guest this week. And those of you that have tuned in to Rob and I over the years, you know this guy, one of our favorites, and who we bring on when we seek to understand the capital markets, interest rate landscape better. Owner, founder, Vice Capital Markets, our guy Chris Bennett. Chris, how many years Vice now? How many years has it been?
This is year 24. Kind of crazy, huh? Yeah, been very, very blessed for sure. Really appreciate you guys having me on the show too. It's always great, especially to get to talk to two great capital markets minds like you guys. It's a real pleasure. So it's a treat. I appreciate it a lot.
The nerds will love this one today. Three guys, capital markets background. We're trying to figure out what the hell is going on with
Try and have some fun too while we're at it.
So, maybe Chris's appearance on the big picture had something to do with the recent downturn in rates. I don't know if the Fed's factoring that in, but Rob, along those lines, I wanted to start the show today. One of the things I've always harped on is your hands up, Rob.
Rich, let me just deflate the sale right now. Rich, let's say you're a loan officer.
Okay.
And I said, and you were doing, whatever loans you were doing per month for a good company, you had a good little market and so forth. And I said, Rich, we're going to have Chris Bennett on the show. Chris will know definitively that mortgage rates will be higher in a year. Or Chris will know definitively that 30-year rates will be the same in a year. Or Chris will know pick three. Chris will know definitively. He knows for sure that rates are going to be lower. Would what you do differ based on what Chris knows for sure is going to happen to rates?
I mean, it would depend on the level of lower and higher. But
Say, let's say, 0.5%.
This
no,
presumes I would know in the first place, right?
I mean, no,
So
not half a, I mean, if you're telling me Chris is going to guarantee that we're going to be at, 4.75, in 6 months, then it might. But yeah, a
right.
nominal change, no.
Good point. Good point. Yeah, I would. The originators that I see out there continue to do their business um, day in and day out. They know where rates are, obviously. Hopefully they know why rates are. And I think that's one of the things Chris is going to talk about today is why rates are where they are. But in terms of the business that the individual loan officer is doing, I think they're focused. The good ones that I talked to, the good ones seem focused on how can I help my borrowers? What is the psychology of the borrowers? What kind of programs does my company have? What kind of programs does the wholesaler have that I'm brokering to? How can I help my borrower? What is their rent compared to the payment that they might have? They tend to be focused on that. They know where rates are, why they are where they are, but they continue day in and day out to be focused on how am I going to help my borrower, regardless of where rates are. So
I think it helps to be educated because
yeah, absolutely.
your borrowers are considering you're their financial expert, right? They've got a financial planner, they've got their mortgage loan officer. You're a financial expert that they're looking to, right, to make sense of this. And especially now that we're going to get into a time period where, who knows whether it's going to be in 3 months or 6 months or whatever that's going to be, where Yahoo Finance is going to come on and say Fed cuts mortgage rates by 0.25%, right? Which we all know that's not how that works, but a lot of the people in the public are going to see that, and that's going to be one of the things that loan officers will need to be educated about and be able to explain to their borrowers as to, well, here's how what the Fed does affects mortgage rates, but it's not going to be that like the headline that you're going to be able to see on your Yahoo News feed.
I agree. I agree. In fact, if you think about, and Chris, maybe I'm stealing some of your thunder here, but if you think about if and when the Fed does do something, right now the yield curve is inverted. If the Fed at some point, first of all, the expectations of them cutting rates will be so great, it'll almost be a non-event.
Yep.
But when they do actually cut their overnight Fed funds rate, for example, I'm wondering if that'll actually help the yield curve become at least level. Maybe nothing happens to 30-year mortgage rates or treasury rates.
But we've already been flattening, right? As the paradigm has shifted a little bit.
It has been. It
Yep.
has been.
I think we've flattened. I think you called negative 47 basis points, but yeah, we've flattened at least. I really, by the way, Rob, I really loved your piece in your newsletter. It's either Monday or Tuesday, where the capital markets section was all about this idea that for the last 50 years, whenever we have an inverted yield curve, it's followed in X number of months picket by a recession, right? And you've actually, obviously we've never had a recession for this entire time, and it's been 2 years now with an inverted yield curve, and a lot of the talking heads that you pontificate about that are pretty vocal from a year and a half ago, constantly saying we're going to have a recession, Fed's going to have to cut, mortgage rates are coming right back down to 3s and 4s. And you, Rob, were somebody who always the entire time said people are saying this, but folks, that's the economic data doesn't bear that out, right? The consumer spending continues to be robust, home prices continue to appreciate, and so this idea that even though yes, historically one doesn't have to trigger the other, right? Inverted yield curve is more symptomatic of things that are going on in the economy, but just because it's happened almost every other time doesn't mean that one has to trigger the other. And you were somebody who always really kind of beat the drum, or at least kind of squashed the drum beating that said, we're getting a recession, it's going to be, all this is all coming back, this isn't going to be happening anymore. It said, that's not the case. The consumer has lots of money and they keep spending it, and there's no end in sight now. And now maybe a couple of years into it, we're certainly starting to see a slowdown there. But all the people that were forecasting a recession for 24 months straight, they're still calling for one, right?
Right. Yeah.
If you call for it long enough, eventually you'll be right.
Eventually, and I very much appreciate you mentioning that, Chris. I look around. Rich has heard me talk till I'm blue in the face about. I walk down the street, or I go in the airport parking lot, the fabled airport parking lot. The flipping airplanes are full now. Granted, they've cut back flights, but the fact of the matter is, when you look at unemployment, when you look at housing's kind of, doing this, going up a little bit, and unemployment's still low, and the consumer spending, yeah, credit card debt is over $1 trillion now, and that could be a problem. But the economy's doing okay, and so rates are where they are. And to your point, to my point, and Rich, jump in here if you ever want to. But the fact of the matter is, it's good for originators to know why rates are where they are, to be able to explain to a first-time home buyer, for example, hey, rates are where they are, and here's why. What's your rent payment like? Let's talk about what your payment is going to be like if we buy that, $250,000 starter home in that school district that you want, and what's the tax advantages and so on. So anyway, all right, Rich, anything you want
No,
to
I
add?
just echo. Yeah, you were defiant, honestly, throughout years of people calling for a recession, saying, "Listen, I'm not seeing it." We just saw data a couple days ago. Restaurants a record year last year, but the data is starting to change, maybe a little bit now. And yet, to both your guys' points, eventually those people will be right. Wondering what lies ahead. We got some big data coming up here. We got a jobs number, obviously coming up tomorrow morning, 8:30 a.m. when we get May employment data, and then the refreshed unemployment rate, and then of course a Fed meeting next week, and then today, I believe it was this morning or late last night, we got a report from the Department of Labor, which was pretty eye-opening. And basically, their quarterly census of employment and wages, cutting through it all, the headline on it was that the Fed may have overestimated job growth last year in 2023 by 60,000 jobs a month. So that's 720,000 jobs annually. We know what happens if one jobs number misses to the bad side by 60K off of expectations. So, Rob, I don't know if you saw this. We've talked a lot about data that the Fed is using, and how solid and accurate is it, but figured I'd kind of get things started today by getting your guys' thoughts on that report and what it could portend.
Chris, I'll let you deal with that because I did not.
Yeah,
I
Rich
didn't
shot it
see
over
it.
to me and I took a look at it. It's interesting. Actually, an old mentor of mine from back in the 90s used to call it the employment lie, where he would say the government issues their current lies and revisions to their previous lies. And in the end, it's kind of it's an exact science, right? So all these folks they've got lots of resources, they've got ways of collecting this data. But you can't know all these things. That data, just like GDP numbers, right? They come in over a period of time, and then you get more data and you revise, and you get more data and you revise. So it's not. I think there's two things to keep in mind: is that are there big revisions to it? There sure are. These are people though that they know how to crunch data. They're constantly having to tweak their assumptions because a lot of these things are being done by surveys, right? It used to be phone surveys. Now they're online of, hey, how many people did you hire? How many people did you fire? Who quit? Add all this together. What sections did you cover? Are you manufacturing? Your sales? Here are the percentages. But it's not a government conspiracy, but there are big revisions to it, right? And I think it's one of the reasons that the Fed and other policymakers take a look at data from a lot of different sources, not just non-farm payroll is this, therefore this, or unemployment is this, therefore that. But they look at a lot of different things. One of the big things that we had come, when you're talking about, Rich, a little bit of softening is the JOLTS report. The JOLTS report looks at basically, it used to be help wanted ads in newspapers. Now it's also through Indeed and all this stuff. But how many job openings are there? How many unemployed people are there? How is that changing? And one of the most really interesting things is what's the ratio? What is the ratio of job openings to unemployed people? Because usually that's right around 1-to-1, maybe a 1.2 to 1 ratio is kind of the average for it. And we spiked once we got through the COVID pandemic lockdowns and all that stuff. It was about 2.5 years ago where we spiked up to this ratio of over 2-to-1, over double the number of job openings than we had unemployed people. And that's when you saw those wage pressures dramatically accelerate. It was a big contributor to inflation that we've had going on month after month that's been softening. But it's taken a while. We've finally seen this reduction in tightness in the labor market. That ratio, it got up to 2-to-1, like it was 12 million job openings, I want to say. Now it's down to just over 8 million. That ratio is down to 1.28. Again, this ratio of job openings to unemployed people. So that's back to, I think the last time we were there was November of 2018. So the job market in terms of tightness, as you measure it there, we're back to a normal kind of time. So the good news is, I mean, this isn't recessionary. This isn't, unemployment's gone from 3.4 to 3.9, right? I mean, that's a very, very low unemployment rate. But what we've done is gotten rid of this excessive job market tightness that was making things very difficult from an inflation fighting standpoint. So that's something that's a recent spat of some pretty good news. And yes, CPI has been sticky, other inflation measures have been sticky, but we're at least getting rid of some of the contributors to that persistent inflation.
Some of this, seemingly softening job data, some milder consumer spending numbers, the last couple inflation figures we've gotten, including PCE recently, have been at or below expectations. And what this is leading to is really a building sentiment that we may get a rate cut before the election. I checked before the show, the CME FedWatch tool that predicts Fed movement, now a 68% chance of a Fed cut by the September meeting, now kind of priced into the markets. And Rob and Chris would just Rob, your thoughts on that.
What did the CME measure tell you like around New Year's Eve? Was it that they were going to cut rates like 4 times this year?
Five.
Five. Now we're at 2.
Yeah, almost. Yeah, probably like 1.8 or something. But yeah. Mm-hmm.
Well, and we've had now other central banks, right? Are kind of we've had
that's true
by them. The Bank of Canada just cut. The
ECB.
Yep, the ECB did their first cut of a quarter point. Well, this morning our time, this afternoon their time. Bank of England's supposed to do their first cut of a quarter point. If they do, it'd be in July next month. So, and we'll be a little bit behind there. And that's okay. But it's a little bit of a shift from, and again, it's not in all these cases, even in our case, it's not like they're easing, right? They're just making policy less restrictive because it's been working. They're not at 2%, but they're well in there. I think the ECB has gone from like 10% inflation to something in the mid 2s. So they don't have to be as restrictive anymore.
It's certainly, it's not as if our Federal Reserve needs to stimulate our economy.
Right. We seem to be doing just fine with that.
Right. Rich, card sales as a measure of economic well-being and prosperity, or is the card market good right now?
It is, yeah, because you got, football season is around the corner. This is kind of when football kind of heats up, and the national sports card shows in July in Cleveland, by the way, this year. So it's a good time for the card market. A lot of the new 2024 baseball products are out. So yeah, if you're looking, maybe the Fed's using that as one of their tools, the Rich Swerbinsky Sports Card Market Index to predict what they're going to do. But
you get to complete the retail sales survey. I like that.
Yeah, exactly. I forgot to return that call. So,
so Chris, speaking of informal surveys, when you go to a dry cleaner or a, or you're getting your shoe shined at the airport or whatever, do you typically ask the proprietor how's business or how are things?
I guess part of my case is a little different. I don't think I don't wear shoes that can be shined.
Well, you know what I mean.
The
no
one shines my Birkenstocks. But you're right. I think it depends on who it is, right? If it's somebody that's your friend that whether it's I don't know, whatever service they're providing, you do. I don't know if I do really other than that. Do you you strike me as somebody, I guess, who does that, right? When you're
I do that. It's not, I hearken back to a story, John F. Kennedy's father, Joseph Kennedy, got stock advice from the shoe shine boy.
Uh-huh.
And I think he pulled all his money out of the stock market at that point because he said, when it gets to the point where the shoe shine boy is telling me which socks to buy or sell, it's something's wacky. But generally speaking, I will occasionally, it's not like I'm a chatty person to begin with, as Rich knows. But if I'm at someplace, I might say to the Uber driver, like, how are things? Or just as a really informal measure of how well or how slow the economy is. And uh, the other day, I treated myself. Boy, this is really opening up the Rob kimono here. Literally, I actually treated myself to a massage.
Mhm.
And, what do you talk to a massage technician about? Whatever. So I asked her, how's business? And she replied, she's been a massage person for 24 years. Olga. Anyway,
Sounds
Olga
like
said,
strong hands.
Yes.
strong like bull. Uh, where was I? Anyway, Olga, she said that business was very good. She's very as busy as she wants to be. And I thought,
And that's a great
that's
example of kind of more of a luxury service, right? When they're going to suffer the worst if there's a true downturn.
exactly. Exactly. So I thought that was telling, right up there with the Serbinsky measure of, we got to come up with a name for that.
The
Rich, have your team work on a name of that economic measure.
you're looking at my team, so we'll get right on it. Yeah. So but good stuff. Good stuff.
Where
So
do you mean your postman biting dog isn't on the team?
oh, man, my dog situation's a different story. I think you could maybe hear my 1-year-old crazy German Shepherd in the background, who's evidently not happy about the 80-year anniversary of D-Day today, being German. So, but it's all over my shit today. I don't know what's going on with it. Anyway, so
Hey, did you like my lead off in the commentary today?
I
Did you not?
did, I did, I did. Yeah, I thought that was
Luftwaffe. I thought that was a good one.
the mechanic. Yeah, that did have me chuckling. You've alluded before. I don't read your commentary, but I just proved it there. So there we
All right.
go.
Sorry, we digress.
Anyway, so getting back to the Fed next week, Chris, it do you expect, I mean, I don't think anybody's expecting any sort of major shift from, any of their policy points or language, but, do you feel like this, some of the data that we talked about recently could cause them to send a different message to the market
Yeah,
when they
I
really?
think that, because you're right, when it comes to the actual statement, it's pretty boring, right? You compare the statement with the previous statement. There's, 2 words that change and 2 sentences that change usually, right? I think the big one is, this is one of the ones where we get the dot plots, where the summary of economic projections. So everybody that's a member says, hey, here's what all my team of economists are projecting for the future of the Fed funds rate and for unemployment and for GDP and all those good things. And when they had the last one 3 months ago, remember it was, hey, the Fed's projecting 75 basis points of cuts this year. And if you really kind of looked at it, there's 17 dots on there, and it was 9 dots for 75 and 8 dots for 50. So I guess majority rules 9 to 8, but really that's pretty much a 50-50 split. So I think that we end up seeing the majority have an expectation of 50 basis points in cuts. And it's data dependent, right? Or as they like to say sometimes, it's data aware. But it kind of lends itself that if you're a Las Vegas odds maker and you got to kind of set your over under for when these things happen, I think if data comes in as expected, it's a cut in September, and it's a cut in December. And one of the reasons for that, I think sometimes there's a lot of people, especially, depending on what news you like to watch, that some people say the Fed, is very political. They want this candidate or they don't want this candidate. I think the Fed really tries very hard to be apolitical. One thing I think that really does matter a lot to the Fed is their independence. And so I think they worry a little bit about, they're supposed to ignore, anybody who's in the White House for the last 50 years tries to, talk to a little bit to the Fed of, boy, it'd really be nice if we could have more accommodative policy. My people care a lot more about unemployment than they do about inflation. Try and take it easy on everybody. And the Fed kind of lends it a little bit of a playful ear, but in the end ignores it. But I think it'd be naive to say that the Fed doesn't care at all, right? I think when Chairman Powell was being up for possibly being renominated 2 years ago, and a lot of the speeches kind of aired on the side that were pretty dovish. And he got renominated by Biden, and then the tone kind of changed as soon as he was sworn in again, and become much more of a centralist tone, a little bit more of a hawkish tone. But so the November Fed meeting, people realize it or not, it literally is pushed out a day because otherwise it would fall on actual election day. So, the Fed really wants to be independent. They don't want to be seen as political. And because of that, I think they absolutely avoid wanting to do something literally 48 hours after an election is held, regardless of who the winner is of it or the outcome. I think they kind of would just rather the Fed have a very quiet time in November. And if they have the room to do something in September, I think they take that opportunity so they don't need to do anything in November. That's just my guess.
So Chris, 2 or 3 months ago, there was some story about Donald Trump or his handlers or advisors suggesting that the president would have more of some more say in setting rates. Do you remember that?
I do remember that.
What obviously he's not president, but do you remember what it was and what the implication might be?
Yeah, it really had to do something about, it was taking a little bit of the kind of unilateral authority that the Fed has and having it be that they had to consult with, I can't remember if it was Congress or the White House. But it was taking away some of that independence. And certainly the Fed the Fed's trying to play this game, right? Of, they want to be very independent. So they don't just want to tell the people who are in power or could potentially be in power that, hey, we don't care what you have to think, but you see what happens every time there's that semi-annual testimony right before the Senate and the House. Whoever the poor sap is that the Fed chair gets up there and they've got to go before the senators and the representatives who sit and pontificate about nothing for 10 minutes. And at the end, the Fed chair says, was there a question in there for me? So they already have to subject themselves to that. And I know the independence really is important to them.
Yeah,
I think actually he came out during that same time period when he was being interviewed and said he's if elected, he'd be unlikely to reappoint Jerome Powell, who he obviously originally appointed back 7 years ago, thinking that he'd be too likely to cut rates because he wants the Democrats to win the White House, which I don't think that there's any truth to that, but that's just, it's everyone serves at the pleasure of the president. So, and I don't know about firing anybody, but I'm sure that might weigh a little bit into their thinking. But I do think that they want to be above it all. They want to be independent. They certainly don't want to be seen ever as partisan.
Yeah, we don't need Marjorie Taylor Greene or Bernie Sanders.
Oh goodness.
Yeah. Voting to set rates.
Yeah.
I think it was more more consulting with the president.
Yeah.
And to your point, I like the Fed being independent. I don't recall. I think President Biden his focus has been more elsewhere. I haven't heard him grouse about the level of interest rates or the Fed's not doing their job. Or maybe I've missed that, but he seems like his attention is not on the Federal Reserve. He's kind of letting them do their thing.
Well, I think, given what we had with inflation for the last 2 years, it's kind of hard. It's kind of hard for him to say, "Hey, we need to cut rates because the American people are hurting." Unemployment is 3.9%, right? It hasn't,
right.
And because he's got the reputation, I think, not reputation, but inflation. No one cared about inflation for a long time, and now it's definitely a top 3 issue for the American voter. So I think it's kind of hard for him to appear to be soft on that when it's such a big deal for so many voters all across the country.
Yeah.
Yeah. This is The Big Picture. I'm Rich Swerbinsky with Onward and Upward Consulting. This week, pleased to be joined by the founder of Vice Capital Markets, outstanding hedge advisory firm based out of the cannabis capital of America, Michigan. Chris Bennett. Chris, and good to see you and take part in the conversation today. And keeping our attention on the Fed, I do think there is, especially, I think in the wake of this report about the employment data potentially being off, I do think that this is going to, continue to get people stirred up. The Fed, talk about people not caring about inflation a couple of years ago. The Fed even, I mean, months and months and months, 6 months of, inflation is transitory, late to the party. Kind of set us down this path. You could argue that, not in as good a position as other countries and how their central banks have handled it. So I think naturally, some of this data that we're seeing now that seems to suggest, hey, employment data is suffering, consumer spending is hurting, credit card debt is at record highs. Some people, myself in that camp, could think maybe they're late to the camp the other way. And if indeed these jobs numbers are, off by that much, and you get more empirical data that could point to that, we could have a scenario here where we could see, pretty some favorable rate news and movement. Again, 68% of a cut, a 68% chance of a cut now priced in September. We've seen that's brought 30-year fixed rates down like 35 basis points, like low sevens to 6.75 range. And, if we get more data that makes September a likely Fed cut near 100%, I guess walk the viewers and the listeners through like that scenario, the data that would suggest that the Fed needs to cut rates in September and maybe a couple times this year, how that could impact, mortgage rates that, LOs are seeing on the street.
Yeah, to my mind, I think a lot of times, not necessarily consumers, but markets are so surprisingly forward-looking, right? When people ask me, "Hey, if the Fed does end up cutting rates by a quarter or by a half by the end of the year, what will that do to mortgage rates?" And I would say to them, probably nothing. We've already, right? Mortgage rates just came down 3/8 of a point because of this paradigm shift over the last little bit of time, as we've had some softer economic numbers come over, of not having to think, hey, are we worried that the next move could actually be a hike, which I think is pretty unfounded, but kind of, hey, is the Fed off the table completely? So, when you look at things like a 2-year treasury and even further out to a 5-year treasury, which mortgage rates are much more likely to be based on, it's kind of this assumption about the month-to-month cumulative effect of different Fed funds rates levels, right? If 12 months from now we're going to be 100 basis points lower versus 50 basis points versus 150, all that stuff's already baked in essentially to the cake. So, when we start to see Fed cuts, is there an immediate benefit from it? I think really the benefit, if you're a fan of lower rates, which a lot of us obviously in the mortgage business are, is what's the expectation for not necessarily this cut or the next cut, but what's the expectation for the environment a year from now? I think it'll be a lot more predicated on that. If you look at you look at the 10-year treasury, just because that's kind of a benchmark, right? Back in December, like you were talking to, when we had 5 rate cuts expected, we got a 10-year yield at 3.80. Those things don't happen; they don't materialize. We see the 10-year yield go to almost 4.80. So those are big swings in there, and kind of like good functioning markets, when you get to areas that are up that high in yield, you start to see real money buying come in, and that kind of normalizes things and brings things back down as part of a nice, normal, healthy, functioning market. We've had, in the industry and the economy, this 15-year period really since the global financial crisis of all or nothing, right? Either boom, Fed funds are zero and we're in the doldrums and everything's terrible, or boom, we have huge hikes, like we've had in the last 2 years. And maybe this is a case where we have something more that we had in the 1990s, where there's just little tweaks to Fed policy. Rates rise for a little bit, rates come down for a little bit, unemployment goes up a little, goes down a little bit, GDP is doing well, it's doing softer, but it doesn't have to be the switch on of just kind of all or nothing. Maybe that's kind of the environment that we're going to be seeing for the next year or two.
So while you were talking there, Chris, I thought of maybe the average person on the street is more interested if and when the Fed does cut, will the rate on my Nordstrom's card go from 30% down to 29.5, Or will it go like to 15 or 10? I mean, how did credit card rate? I'm not a credit card expert in the slightest, but how the credit card rate 25, 30% for some of these ordinary, Home Depot or Nordstrom's or Macy's or whatever, and people are paying it. How did it get so high? Isn't it a matter of we're going to charge what the market will bear? And sure, the Fed is going to lower 1/4%, but I'm still paying 30% on my Nordstrom's card.
Yeah. And I mean, usually anybody who's paying that kind of rate, that's the penalty rate. That's right. That's the rate for you're late on your payment. You can't get a better offer anywhere else. Because if you could, you would just take one of those credit card offers that says, hey, 0% interest on balance transfers for 6 months. And you would just do that, right? Or 5% interest. Anybody who's paying 29% is because they've got themselves kind of a financial pickle, I would think, right? And they can't do anything about it.
So the last time I looked, not to disagree, but the last time I looked at www.nordstroms.com and clicked on the credit card offer, I think in the fine print it said like 25%. I mean, it was nuts because somebody told me about it. I said, no way, it can't be that high. It's got to be for people who are in trouble. And they said, no, if you want to go to the Nordstrom's right now and get a card, that's the rate you're going to pay.
And that's the rate if you don't pay it off the month you get the bill, I assume, right?
Yeah.
Yeah.
So I need to revisit that, but I think
I bet you're right.
but that is impacting the person, the average schmo. So many millions of borrowers out there are sitting there happy as clams with 2 3/4 or 3 1/4 or whatever 30-year fixed or 15-year fixed mortgages. It's not that they don't care what rates are doing, but if they don't have a lot of credit card debt and they're sitting there at 3%, rock and roll.
Do you think that there's a case where we've got, obviously there's lots of homeowners and borrowers who are locked into very lower rates, don't want to move because of that. But could there be actually mentally a paradigm shift where once we get the first cut and I guess the paradigm becomes rates are going down, even if we all just kind of talked about, hey, it's kind of baked into the cake. Does that actually help put more homes on the market? Because people say, hey, the worst is over. You know what? We've been wanting to move for 3 years and we haven't because we're kind of locked into this. But now my desire to move is becoming higher and higher. At the same time, I see the light at the end of the tunnel. It's all over my Yahoo Finance page or wherever CNBC people are getting stuff from. And mortgage rates are going to come down. Let's go ahead and just do it. They should come down even more, and we can even get a lower payment next year. I mean, do you think there's a real effect to that outside of what happens to mortgage rates, just the outlook changing?
Well, yeah, obviously psychology matters quite a bit, whether you're talking about stocks or bonds or gold or cryptocurrency. But I immediately hearken to, and Rich has heard me tell this story and I know we're like out of time, sorry, but I would go visit my mom. They bought their house in 1967 and I would visit them all the time throughout the 70s and 80s and 90s. Saratoga, near San Jose, Santa Clara Valley, the price was doing this. And I'd say, Mom, look at this flyer I got at Safeway. Look, I bet you could sell your house for this. And she'd say, fine, where are we going to live?
Right.
And so you have a lot of baby boomers out there who are going to say, hey, that's great. Where am I going to move? I like it where I am.
Mm-hmm.
I got a 1-story ranch style house, easy on my hips. I like the neighborhood. I own it outright, or I've got a 3% loan, but am I going to sell it? Maybe I'll downsize. Maybe I'll go to where my kids are because my grandkids are there. So maybe there's some of that going on. There's always death. There's always divorce, but I don't know if, it would take something like the Serbinsky tax plan, which is, obviously on Congress's plate, considering some kind of tax break for people to actually sell. So
That would be great.
I like that idea too.
This is the big picture. We got a few minutes left with Vice Capital Markets founder Chris Bennett, and wrapping things up. There's some stuff in the chat, a lot of good snack food jokes and mentions, Funyuns, Fritos.
You wake up said Fritos.
Somebody asking if Rob demonstrates said behavior when playing tennis. That was right at the beginning of the show. I forget what we were talking about, but question for Chris. Would love to hear how Chris's thoughts on the wide bid-ask spreads on Ginnie Mae TBAs and how that affects cross hedging, and what recommendation Chris gives on such instances. It's a slightly tied topic. Ginnie is now allowing e-notes in their pools too, Chris. So your thoughts on Ginnie, TBA, wide bid-ask spreads, and e-notes in Ginnie?
Yeah. Yeah, not to get too in the weeds, I guess, but yeah, there's a lot of times in the MBS market now that we don't always have great markets to trade in. Sometimes they're tight, sometimes they're not. And part of that's just a function of there's a lot more Fannie and Freddie stuff out there than there are Ginnie things out there. And also because, you know, mentally, from a trading standpoint, UMBS, Fannie, Freddie securities, that's the benchmark. And Ginnies trade on a spread to those. So sometimes there's nice, good functioning markets there, and sometimes there just isn't. And part of what it takes is because we've only been making, so we kind of think of the world as originators, right? We think about, well, I'm making securities that are 5.5 or 6 or 6.5, and we all are. But most all the securities that exist out there are this big gaggle that we made back from 2020 to 2022 of 2s and 2.5s and 3s. So we don't yet have enough of a base of these new securities that we're originating to have as good of functioning markets as we're kind of used to having for the last few years. So the thing that kind of solves that is it's time. It really just takes time. So, you know, the person I was, they already, I don't know who submitted the question, but they're well versed, it looks like, in cross hedging and kind of looking for, hey, how long are we going to have to do this for? Because it's a risk reward of you want to operate in tight markets, but you also want to be careful about how much kind of basis risk you're taking on Ginnie securities moving versus Fannie and Freddie securities moving.
Speaking of Fannie and Freddie, 7.1 billion in net profit in Q1. This is after over 80 billion in profits the last 3 years, getting funneled into the treasury coffers. Just an open question for both of you. Like, how long before this starts to get its way into the news? Just the insane profitability of the GSEs in the midst of an affordability crisis. Guarantee fees are 63, 65, 66 basis points. Delivery fees, the Federal Home Loan banks aren't even charging them. Fannies are still, most would argue, excessive. Some thoughts on when this starts to weave its way into this affordability narrative? It's a tough off-script question for you guys right at the end.
Rich, I mean, we could talk for an hour about just that, but did you say bolstering the treasury coffers?
Did I? Is that
I
what
think you did.
term I used? Yeah. Was that not? No.
No, I think the net worth of the agencies right now is north of $100 billion since they've been able to retain their profits. And so
Just imagine, do you consider them part of the government or not, right? Since they're still under conservatorship. Even though it's right, it's not going straight into Treasury anymore.
Right. I
Dotted line. Yeah. I mean, you know,
Rich, Rich, you fumbled the ball there. Don't worry about it. It's not going into the Treasury's coffers anymore. It's I don't know. They're charging what the market will bear, right? People still want to buy homes.
Yeah. Or are they charging what FHFA forces them to? Right? Are Fannie and Freddie really truly competing against each other?
I think George Soros is involved there somewhere.
I think you could argue Freddie's been much more aggressive and is seeking to compete against Fannie. Maybe not vice versa, would be my take on it. I saw some graphs this week just about the credit by the average credit metrics on Freddie and Fannie loans. Freddie clearly taking on more credit risk in terms of lower FICOs, higher LTVs. Obviously, you know, they proposed the equity loan orgy that you know is you know could be really substantial to the housing market. So to me, Freddie is acting very competitively. I mean, given the handcuffs of FHFA and the conservatorship.
I saw a survey that just came out. They FHFA and Bloomberg put out basically a survey asking about the Freddie Mac second mortgage product to all sorts of players, depositories, IMBs, regulatory folks, independent kind of think tanks, investors of, hey, is Freddie Mac offering this up to 80 LTV? Is this a good idea to allow this? And I looked, the answer kit was like 4 choices you could have. You should say definitely bad, probably good, or definitely good. And it was 45% said definitely not good, 15% said not good, and then a total of 40% that either said good or very good. So it's kind of, when they kind of took the pulse of the market, it was about 60-40 against it. I've kind of, to my mind, it's like,
Rob firmly on record as saying he thinks this is going to go through. Rob, have you wavered on your stance there? I think FHFA, they had 30 days to make a decision after the comment period closed. I think that's like, I don't know, it's like June 20, or it's coming up in like a couple of weeks, I want to say.
I'm still.
You're holding the line. Bring on the equity loans. All right. Chris?
I'm not saying it's a good thing.
Prediction. Yeah. Irregardless.
There's conversation out there about, is this, the industry has always been afraid of Fannie Mae and Freddie Mac overstepping their bounds and dealing directly with borrowers. And Fannie Mae and Freddie Mac have always said, we don't want to deal directly with borrowers. That's your job. But this is viewed as, a potential step in that direction. So anyway.
It feels like something that's
what you think will happen there?
I don't know if I know what's going to happen. To me, it seems like it's a non-problem, right? It seems like it's being very, very well served by depositories. It's being well served even by large IMBs that are going out and putting that out to market, even smaller IMBs. So it feels like, why do we need to have an agency's nose stuck in something that doesn't need it? That it's not currently a problem that needs fixing, right? We need the agencies to provide liquidity and
stability
to a 30-year fixed rate mortgage, because banks and credit unions don't want to put fixed rate things on their books. So it's a great use for the agencies, but to my mind, getting them involved in second mortgages is a problem that doesn't need it. It's a problem that doesn't need to be solved, because it's not a problem.
Wrapping things up here on
great answer.
The big picture. And Chris, as we take this thing home, we've now seen 8 quarters in a row of negative profitability for mortgage bankers. Any advice to the mortgage banking community as we seek to reverse that trend and meander off into greener fields here?
Yeah, I would tell you one thing that I see when I look at differences between companies that are making money and companies that aren't. It's not just the obvious things that, I mean, shoot, like you said, it's been 2 years, right? It's been 8 quarters. It's not about, you can't cut your way to greatness. But one of the things that a lot of companies don't look at is how they price loans to the primary market and what their competitive situation is. They focus too much on basis points and not enough on dollars. So if MBA comes out and says the average cost to produce a loan is $12,000, and you've got companies that just say, well, I'm going to grab everyone's best efforts rate sheet prices and includes these payups for low loan balance loans, and I put that in my pricing engine and my loan officers get it, and that's what it is, and I put on my 3-point margin. So you have a 3-point margin on a $150,000 loan. So you have $4,500 in revenue, and MBA says your average cost to originate a loan is $12,000. That's not a winning formula. So, and of course you can't price a loan to make 10 points, but companies really need to, from a pricing standpoint, these same companies will be the ones that say, boy, we're killing it on the $100,000 loans, but we can't compete at all on the $600,000 loans. Hello, there's a reason for that. So stop being, quote unquote, the lazy way out and just saying, I pass everything through the primary market. I have the same fixed margin and that's how I do loans. You're not priced optimally. You're giving up way too much on loans that you're losing money on. You're not able to compete successfully on loans that you can compete successfully on if you change your mentality from basis points in pricing to dollars per loan in pricing, and covering your costs and making some money there. That'd be the one biggest piece of advice I think that companies who look at 15 different ways they can save money aren't looking at in terms of how they can more properly compete and grow revenue.
Good stuff. Want to thank our guest today, Chris Bennett, Vice Capital Markets, as always, for joining us and shedding some light into one of the confusing parts of our business, how the capital markets work and how Fed machinations, impact the rate sheets that we see and prospective home buyers see on a daily basis. So Chris, thank you as always.
Thank you. I always learn so much talking to you guys. Really appreciate you having me on.
You got to throw at least one Michigan barb at me. I about left the scene of the crime.
I
Michigan, he's out in
knew you
LA.
were going to say scene of the crime. I'll tell you what, my uncle always told me, boy, if you ain't cheating, you ain't trying. So that's what I'm hanging my hat on.
I did subtly throw a little scarlet and gray on today.
Was he like Al Capone's accountant or something, or what?
I'm trying to do his voice properly.
And where's Uncle Louie now?
God rest his soul.
Rob, Dan Hurley to the Lakers. Any thoughts on that to take us into the weekend? Looks like that could be happening. They're preparing a massive package for Hurley.
They've got the money. Finals start tonight. I'm excited.
I can't wait. I hate, these are two of my least favorite teams in the NBA, but I'm very excited for the matchup. And just to see some good hoops, man. It's gonna be fascinating to see Luka and Kyrie versus Tatum and Brown. Can the Celtics get over the top? The Porzingis factor, just a lot of good storylines in this one. Any prediction, Rob?
I think the Celtics will win.
Yeah, I think Celtics in 7. I think it's going to be a long series. The Celtics depth worries me a little bit. Missoula definitely worries me. Jay Kidd versus Missoula is that's a mismatch, but we'll see. We'll see what happens. And
it'd be fun watching NBA players actually play defense.
Right, the playoffs, right? Exactly. Yeah.
We play defense in May and June.
Like the last minute of the All-Star game. Yeah.
Right.
Well, good stuff. And thank you, as always, for joining us. If you're listening live or where most of you listen on podcast, YouTube, these go right to pod and YouTube as soon as we get done on Thursday afternoons. And want to once again thank Chris Bennett from Vice Capital Markets for joining us once again today. Chris, appreciate you joining us.
Thank you, guys.
All right, good stuff. And we'll see you guys next Thursday at 3 p.m. Eastern on The Big Picture. Have a great rest of your week and the weekend, everyone. Take care.